Good morning, everyone. Time for another silver update. This one is a little bit out of sequence. I had a large number of math formulas spinning in my brain trying to figure out who's right on this issue of the margins. So I figured I'd present you with some of the work that I've done so far. I want to apologize to John from Stella Concepts. I didn't do my charting correctly, and I wanted to correct that now. If you remember, we had done charting with the silver chart, and we overlaid the gold chart to do a comparison. And if you remember, we did a overlay, which basically gives you the top and the bottom of both markets, and it doesn't show you the runs relative. So what we want to do is choose relative 2 instead. And when we do that, we get more of an accurate view. The problem is that we can't change our scales. So we can see this on the 1-minute chart, but we can't see the changes, or we can't change the time selection. So we're going to pre-select the time that we want out to the far time frame. So let's do that. We'll do silver, and we'll do it out to the weekly time frame. And then we'll go back and we'll select gold spot, and we'll do relative 2. Okay, so now this is a more accurate representation of what John is talking about in regards to the percentage moves. Now, that doesn't mean that I agree, but it does mean that this chart more accurately shows the outline percentage moves in silver as opposed to gold, which you can see they really began roughly August of last year when silver started to blast off in relationship to gold, pretty much anything else. So the contention that we want to look at is the question of why were these dramatic COMEX, CBOT, CME margin increases instituted. Now, my contention I'm going to make is that they were to stop the price rise of silver. Now, John from Stella Concepts has contended that it was because of the large percentage moves which endangered the position of the exchange, and I hope to prove that wrong in this video. Before I do that, I wanted to look at an article that sort of addresses this issue, and it's on Zero Hedge. This is titled How the CBOT, COMEX, and CFTC coordinated to break the last silver price surge. So this is my contention, that the purpose of the margin increases, the 5 margin increases, their purpose was to break the price surge. It had nothing to do with the volatility of the silver price, and I'm going to try to prove that. But before I do that, I want to read an article, and it's by Urban Redneck, and this pretty much summarizes the contentions about why they did it. So interesting insight by this guy, so I'll go ahead and read it. Major commodity producers outside of the PM markets currently maintain outsized commodity trading departments in relation to their hedging needs for production because they need to maintain the size and strength in the paper markets to shake the price free from the paper commodity banks when their shenanigans get out of hand, or trade their way to a fiat profit. They are unable to free the commodity price. In a fiat world where there is a paper product to meet every conceivable financial desire, the fact that large commodity producers, agribusiness, mining, petroleum, would engage in off-exchange forward physical commodity swaps, which are inherently less cost-efficient than their fiat counterparts, should be a warning to smaller market participants as to how rigged and expensive the paper commodity game actually is, even at the top. Large market participants have an inherent advantage over smaller players in any financial market exchange. When the COMEX is finally banished to the 8th circle of hell, new exchanges will emerge to replace it. Hopefully they will achieve more honest price discovery and will better represent the interests of producers, and small market participants and less represent the interests of politicians and bankers. A movement away from dollar hegemony will be painful to those who measure their wealth in nominal dollars, but it will strip some of the power of politicians and central bankers to destroy the wealth of their nations through policies of monetary debasement. The actions in the tiny silver market over the last week demonstrate the determination, power, and collusion of politicians and bankers in preventing honest price discovery. They lay bare the lies of BLS propaganda as to inflation and the diminishing purchasing power of the masses through unsupported fiat currency printed at the will of central bankers. The actions in the minuscule precious metals markets struck at the fiat heart and reverberated through the much larger oil, food, and currency markets. The immediate CME and bullion bank concern, within the confines of the silver futures market itself, is not directly related to either covering shorts or the paper price, especially since the short positions were opened with monopoly money to begin with. The primary concern is controlling the flow of the underlying physical silver and buying time to keep the Crimex scam alive. The longer the Crimex scam remains viable, the more money they make for themselves and the more wealth destruction by central bankers they can hide. By shaking the week-long positions out, they now control more of total open interest and did so at a lower cost and higher profit than possible in a fair market, as there are less outsiders capable of removing whatever pot of physical silver remains in their vaults through the exercise of long contracts. And he goes on to give an example of a crooked poker parlor and how the Crimex is similar to that. Very good analogy. He also goes farther into this conspiracy. He says, in the past several decades, politicians and bankers have created a worldwide fiat cathedral to honor Satan, conveniently denominated in US dollars, primarily benefiting US politicians' spending desires. The bargain was struck in the hope of receiving financial stability and increased spending. Power at no cost to politicians or bankers, but rather at the cost of the wealth and souls of the masses commanded and controlled by the very politicians and bankers striking the deal with the devil. The gold market forms the vault of the cathedral's crossing, and the silver market forms the keystone of the central vault. The equity and debt markets form the transept, the broader commodity futures markets form the choir, and the remaining derivatives market form the huge nave, primarily consisting of the interest and FX derivative markets. The central banks maintain gold reserves to back the bullion banks in their battle against anyone trying to bring down the gold market. The central banks do not maintain silver reserves, and questions about depth of bullion bank reserves in the COMEX, SLV, and LBMA vaults are leading to serious arch balding. The collapse of the keystone can bring down the crossing vault and the entire cathedral roof. But how else can the masses save their souls from the devil, who continues to extract his pounds of flesh through inflation masked as diminishing purchasing power? So, interesting analogies here. I think the cathedral analogy, or some Masonic analogies here. We got the making a deal with the devil, but this is a very good synopsis of the position that I'm going to espouse, that this collapse of the silver price that we've recently seen is not based upon an attempt to preserve the market functioning of the COMEX, but it in fact is an attempt to collapse the silver price specifically. So let me get to that analysis. So we're going to go back to our silver prices, and we're just going to go ahead and use the SLV. So what we do is we go to historical prices on the SLV, and we'll get all of these prices and volumes and everything else. What we want to do with this is we're going to download all of these to a spreadsheet. And when we do this, we're going to get a table, and we want it as a comma delimited file. This is going to be all of our prices. we've got the date, the open, the high, the low, the close, the volume, and the adjusted close. So we're going to take these three here because we don't need them. We're going to get rid of them. And we're actually going to insert a column here. And we're going to call this column, this will be the difference between the high and the low. So we'll just call this column the sum. And then over here we're going to do a percentage column. So what we want to do to create this sum is we're going to take the high and subtract the low. That's going to give us a range of the price movement in a day. Now, some can say, well, you need to go from the low. You need to there's a lot of things you could do. You could go from the closing to closing. I think going from the high to the low is actually a pretty good indicator of the volatility of the market. So the way we're going to do this is we're going to take column C, and you have to put an equal sign to create a formula. And this will equal column C2 minus column D2. When we put that in there, we get the difference. What we'll do is we'll take this sum and we'll just extend it all the way down to the bottom of the column so that we can see for every day the SLV has traded, which I think it is roughly in the 2006. And now don't get thrown off by these numbers because it's split. So that's actually 10, but that won't affect us when we get to percentages. So now we want to do percentages. So the way we're going to do this percentage is we're going to say that this column equals column, we use the closing price, so that's column F2. Actually, we're going to use E2 because we're going to divide, so column E2 divided by column F2. That will give us our percentage. So now we'll click in this box and we'll draw our percentage all the way down as well. Now what this formula is giving us is we're taking the daily range of price from the low to the high, and then we're making up a percentage of the closing price. So for example, our high on the last day we traded was 35.57, our low was 33.6. That's a difference of 1.97, and then we will take that 1.97 and divide by the closing price to get the percentage move, variability move. Now, the reason I'm pulling these numbers is to view John's contention that the reason why the margin hikes occurred is that the percentages were getting extreme. Now, we can just examine our column. If you remember, it was around the 1st. I think it was Friday. Was it the 29th? Was Friday the 29th? So we'll go back and see the last trading day of April was the 29th. So we have to go by everything before this and probably even before that. But you can see on that day our range was 3%. We had 3, 4. There's a 7% day. 2, 5, 2, 2, 3, 3, 2, 3. So it seems that those percentages are growing. So one of the contentions I wanted to examine is whether or not these percentages have been unusual and would require the type of unprecedented margin increases that we've seen. So one thing that is interesting when we look at this, if we go all the way back to the beginning of the column of figures. If you look, let's look at some of our percentage moves that we had when the SLV was first introduced. Now this price here is 12, and that's, you're looking at 12.9, because remember the SLV split at one point, but it doesn't matter now that we're at percentages. So the difference was 11, and but it's in the hundreds. So let's look at our percentages. The first day of trading we had 8, 3, 2, 7, 4, 2, 3, 3, 2. Let's go further into the series. 4, 3, 2, 3, 2, 4, 4, 9. Let's go further into the series. 4, 5, 2, 2, 5, 6, 3. Now we're up to, let's go into 2007 and just do a random look. We're looking at very small moves, 2, 1, 2. And let's get to 2008 when we started seeing some of the major moves, especially associated with Bear Stearns. Here we have up and before the Bear Stearns, and then through it, 5, 4, 4, 3, 3, 3, 2, 2, 5, 4, 6, 4, 2, 3, 3, 3. So what this number series proves, here we go, 7, 6, 5, 7, 3. What this number series proves is that John's contention is wrong. This move could not have been based on percentage changes, because the percentage changes, except for 1, 7 that we saw right here, none of these prior percentage ranges were even at the high end of what the historical percentage changes that we've had all the way through, because remember, the price is higher. So on a percentage basis, these price moves aren't that great. So what this demonstrates is that these margin moves that took down silver did not have to do with the fact that these percentages were too high. They had to do with the fact that the price was too high, and that the COMEX and the CME and the CFTC and the CBOT all conspired together to crush the price of silver, not because it was moving too high of percentages, but because it was moving too high. So I challenge John and others, if you can refute these numbers, go ahead and we'll see what we get. We'll talk to you next time.